Thank you very much there, Tembegile. Well, South Africa's economy, as you've heard, contracted as expected by 1.5% in the third quarter of 2021. The violent looting and unrest that left 300 people dead in July has played a major role in the country's economic fortunes. Major sectors such as mining, agriculture, import and exports registered disappointing dips as well, with load shedding and COVID-19 related restrictions between July and September also playing a role. We are now joined by Peter Attard-Montalto, the head of capital market research at Intellidex, to make sense of these numbers. Peter, just like the unemployment rate for the same quarter registered a rise of 660,000 jobs that were lost due to the looting and unrest, we are seeing now that it has also stalled South Africa's economic activity. Let's start there tonight and talk about the importance of that particular event when it comes to these GDP numbers.
Good evening. Well, this was slightly worse than expected. We've been looking for a number about minus 1.2 or so. I don't think you can blame all the weakness necessarily on July. I think if we look particularly at the weakness that came through here on the agricultural sector, should not have really been affected. Output should not have been affected by the unrest. But there are signs of deeper, I think, problems here and a slower recovery. I think it's very important to take this data with the much worse employment data, which actually gave us a very detailed geographic breakdown as well. And quite clearly, the problems are much wider than simply KZN or Gauteng. So this is an unfortunate base to build a recovery off of. It's going to, I think, cause a downgrading of expectations for growth from this year. We were at 5.3, we're downgrading to about 4.8 or so. And of course makes us think a lot about issues like revenue for the fiscus going forwards and other sort of risks that start spiraling out of this as we think about a pretty challenging 2022 with load shedding and a tightening of global interest rates environments, etc., and a lot of buffeting of the recovery.
Peter, you are one of the organizations as Intellidex that is likely to revise downwards the 2021 GDP projections. Where are you at this present moment in terms of that forecast?
So that's where we're going to be going from about 5.3 to about 4.8, and those numbers look very high, but let's not forget the huge negative last year of minus 6.9. So we are not basically getting back to where we were in 2019 for longer, and I think this is why we are thinking levels of output term, not just some of these numbers that look artificially high because of the very weak 2020 that was experienced. But really the debate that's going on that is key for investors, for Treasury, for government, is where is medium to long-term growth that's ultimately going to generate the labour absorption that will reduce unemployment. And if there are signals from this data that underlying growth, excluding what was going on in July, etc., is actually weaker, then it reinforces a view that in the medium run we're probably only going to be getting back to a number of the order of 1.7 or something like that, which is basically roughly the same as population growth.
Let's talk about gross fixed capital formation, that is investments in general, and now standing at 14% of GDP in the third quarter, and we come from the highs of over 20% in 2019 recently. What do you make of this?
So there's been a precipitous fall in recent years, actually, in this data. Let's not forget that the government targets, as part of their infrastructure push, 30% of GDP. But basically there is a clear stalling both of FDI in any great size and more importantly of domestic investment into South Africa. And this is a key number that a lot of people look at. I mean, generally you expect fast-growing economies with rising productivity, with a dynamic labour market, to have a number here north of 20%, certainly. And so this provides a pretty bad signal overall, and it speaks to a lot of the underlying reforms that we need to see come through to boost this number, whether that's spectrum, whether that's electricity market liberalisation, that has to happen. The central control over looking at infrastructure, etc., is not really going to, and has not so far, lifted this number to a more acceptable level. So this is really a very weak number versus South Africa's peers.
Peter, we also know what happened to global demand when it comes to trade globally, but exports and imports are also weaker in the third quarter. Let's talk more about that, whether South Africa is alone when it comes to registering those low activity in that sector.
So most of the shift here that we saw, and quite a drag from net trade in Q3, came partly or mainly rather from the export side, but I don't think was really a function of global demand. I think most of it were interruptions in July in the ports. We also saw after that, of course, the Transnet hacking issue. We've seen economic sabotage around Transnet in particular in Q3 as well. I think all of this is creating quite a lot of problems in terms of exports from South Africa, and explains some of the weakness. But I would say with the global economy doing moderately well, in particular the rest of the continent doing moderately well, this data was definitely soft on the trade side, and reinforces the need in 2022 and beyond to look at faster, more export-led policy that really aligns with the African Continental Free Trade Agreement and growing opportunities.
Let's talk about also the issue of how the other parts of monetary and financial policy might actually react to this. With this poor performance in GDP release, I'm not sure whether you think this might deter the Reserve Bank's MPC from hiking the repo rate further when they meet in the first meeting next month, as they've said that we should anticipate a 25 basis point hike in interest rates for every quarter of 2022.
So they've almost said that. The model has said that, certainly, and really it's a battle between their model, which is looking quite hawkish, and what will actually happen. We think they'll hike maybe slightly less than their model is penciling in overall, given this low growth situation. But really the January meeting, I think, is going to be very much about the higher oil prices, the higher petrol prices. We're going into a wage round as well, increasingly, where the SARB wants to be very cautious about capping inflation expectations that feed into wages, preventing there being second-round effects into wider prices, wider inflation. That would cause the need for much more tightening later down the line. So I think the SARB probably can move again in January. But overall, I think we need to take a step back, and on monetary policy we need to consider, despite some of the outcries there have been from various quarters, including the SACP over the weekend, that monetary policy still is exceptionally loose by historical standards in South Africa. There was an exceptional amount of accommodation being provided into the economy from the SARB, and we're very marginally nibbling away at the edges of that through next year. This is not really a tightening that is going to derail the recovery. The recovery is much more dependent on underlying reforms, on demand problems, on sentiment problems, I think, which are functions of politics, of reform and policy and all the rest of it.
One of the issues of policy uncertainty, Peter, has been the land reform question. And today we saw the National Assembly not failing to actually vote in favor of the Section 25 repeal, which would see expropriation of land without compensation. How is the market really likely to respond to the fact that the lawmakers could not come to an agreement on this important policy issue?
So I think the fascinating thing about today, right, was there was no reaction at all. This was a complete damp squibble of an event in the end. I think most in the market weren't even aware this was happening until I started sort of highlighting it in the morning. And, if we thought back, say, a year, 2 years ago, we would have expected originally this day to be a massive event. Maybe there'd be protests, maybe there would be massive song and dance of the ANC getting a 2/3 majority. But no, I think it was clear having followed the committee process very carefully for the last few years, it was very clear from June this year that the ANC would not get a 2/3 majority. And so today was sort of a foregone conclusion, but nevertheless a very historic event. I think really the concern now from a lot of investors is that we are going now into a much more murky process around the expropriation bill, which has now come into committee. And that process is a lot more challenging because you just require a simple majority, of course, to do whatever you want in terms of expropriation without compensation. It highlights, of course, the pointlessness from a pure logistical point of view of the Section 25 change, but also I think raises a lot of risk for people around property rights and around the rule of law. And we'll have to see if this route through the expropriation bill gets challenged in the Constitutional Court. I think it's highly likely that it probably would be how the ANC currently perceives it. But no, I mean, investors are not looking at this issue at all versus a very intense focus that there was on this when it first came up 2 years ago.
Looking ahead now to Q4, the current quarter that we're in, SA is still on the red list. We've seen high levels of load shedding, and President Cyril Ramaphosa has also said that he will lead a cabinet meeting to decide on how to respond to the rise in coronavirus numbers. This doesn't bode well for the quarter and that we are currently in, seeing that he's coming back from that tour, and many people are expecting him to introduce stricter lockdowns. How do you see Q4 panning out?
So when we think of the grand scheme of things of lockdowns, we're not going to see anything like the first wave last year in Q2 in terms of lockdown. If we can see a vaccine mandate put in place that restricts indoor gatherings to the vaccinated but allows, say, outdoor gatherings to the unvaccinated, in reality there should probably be very limited economic impact from further lockdown steps, some marginal impact on the hospitality sector, some marginal impact, say, if there is another alcohol ban, which I think may well come. So in my mind, actually, the red list, the tourism impact, the cancellation of bookings may actually have a larger impact on the macroeconomy than actually the domestic-related lockdown measures that may come in the weeks ahead. Of course, if the government and if the president remains very risk-averse on vaccine mandates, he may want to diverge from the new sort of liberal view that's emerged on this and actually institute more lockdowns. And this is really what we're waiting for guidance on now. We've had some agreement in NEDLAC today and into maybe a presidential address at the weekend through the NCC meetings in between. But the big event on growth for the quarter certainly was load shedding. We've had a record level of load shedding this quarter, which is really going to drag growth back. And we're actually probably going to see the economy actually flatline on last quarter's, or this data out today's week Q3, which I think is not positive. And we're actually looking for load shedding to happen through the whole of next year, which is also pretty damaging to growth. So I think Q4 is going to be quite a soft quarter, not really recovering from the low base in Q3.
Peter Attard-Montalto, the head of capital markets research at Intellidex, all the way in the UK, they're giving us a hawk's eye view of what his take is on the Q3 GDP numbers that were announced earlier today.